Hi, this is Carla Merlack with Merlack Tax Advisory Group. Last night I had the opportunity to speak at the Algonquin Library, and I thank Virginia so much for allowing me the opportunity. I know some of you were not able to attend, and others that weren't aware of it or just not close enough, so I found it important enough to record this video and go over the topics on the most commonly overlooked tax deductions and what's new for 2015 filing season. My goal is to empower you with the information and tools you need in order to keep more money in your pocket by paying less in taxes. What we'll be covering in the next few slides is why am I paying tax on Social Security, how you can increase your income and pay less in taxes, the most commonly overlooked or misunderstood tax deductions, and also the tax law extenders and which ones have been made permanent. Let me briefly recap what we do at Merlack Tax and why we are positioned to make sure that you're in the best financial situation. First, we are the home of the $69 tax return, which is for your personal 1040 federal and Illinois state. No hidden fees, no extra expenses for individual schedules. Tax advisory, guiding you so that you're proactive rather than reactive and being able to make the right choices throughout the year to make sure that you are in the best position tax-wise. Tax reduction, let's keep more in your pocket, and that happens through some tax advantage savings vehicles and many times. Asset protection, income planning, wealth transfer, 401k rollovers, IRAs, life insurance, and health insurance. Let's talk taxes. First, I want to cover paying tax on Social Security. If you're working or you work during your lifetime, you may remember a line called FICA, a deduction. That was paying into Social Security for your future benefits, and that was taken out of your check after tax, meaning you paid tax on it. So why are we paying tax on it again once we start receiving Social Security? Well, a lot of people are under the misconception that it's age that determines whether you pay income taxes or not, but it isn't. Social Security tax is based on income, not on age. And sometimes by being able to control income from all sources, we're able to reduce or totally eliminate tax on Social Security. Are you paying taxes on money you don't use? Let's see if we can take control of that. You might be wondering how that works or what it would look like. So this is a quick example of somebody who actually came to me, a single person that had interest from the bank, dividends, IRA distributions, a pension, Social Security. Their total taxable income was $42,635. I want you to take particular note to this $18,000 of Social Security, of which $10,535 was taxable. Reason being, the numbers above that line, all of the other income. The tax bill in that current plan was $3,473. By shifting some of the money that was in a taxable interest account and a taxable dividend account, we were able to take that money and create income of $600 a month, non-taxable. Therefore, we were able to reduce the IRA distributions by $200 a month and take note of the Social Security. Taxable amounts dropped to half, only $5,000. Now the tax due is only $1,875. So we were able to create an extra $533 a month income. That's what tax advisory is about. At Merlac Tax, we last year prepared about 750 returns. And every year I see at least 5 cases where somebody has made a withdrawal, a distribution, unknowingly creating a huge tax liability. And I can't blame them because they don't know what they don't know. That's why I encourage everybody to contact us for a complimentary review during the year to make sure that they're not making any decisions that they're going to regret when it comes to filing taxes. So taking this example, using the scenario of the previous slide, normal income taxable was $30,703, tax bill of $1,875. Well, I took out $25,000 from my IRA to help my kids. Whoa, look what happened. The new tax bill showing the extra $25,000 in IRA distributions now created taxable Social Security triple the amounts previously, taxable income just under $66,000 with a tax bill of almost $9,200. So it cost $7,298 to get $25,000. That's 29%. I think a loan could have been found for a much less expensive interest rate. So please don't make errors that you're unaware of what the tax implications are. Do you have rainy day money that's creating extra taxes? Most people do have money set aside for emergencies or for future plans or maybe inheritance. And many times that money is positioned in savings, CDs, money markets, or mutual funds. As we discussed in a previous slide, those dividends and interest can be creating extra taxes unnecessarily. Those earnings are taxable every year. By shifting that money to a tax-deferred or possibly even tax-free account, you may be able to save hundreds or even thousands in tax dollars. Retirement plan distributions. Well, if you're under 59 and a half and you use some of your retirement money, you typically are subjected to a 10% penalty considered an early distribution. But there are laws and ways that you can avoid the 10% penalty, and many times through an interview with your tax professional like myself, we can find a way that maybe the expenses could qualify under one of these exceptions. Disability must be total and permanent. That's both on company-sponsored plans and IRAs. Quadro, this is for divorces, qualified domestic relation order. This is on company plans like a 401k. If money needs to be split and distributed, the 10% penalty can be avoided. Higher education. This is only for IRAs, and I've seen this mistake be made, people withdrawing money from a 401k or 403b for higher education. But it can only be drawn from an IRA. Simple strategy, we can create the IRA, then do the distribution to be used for higher education, whether that's for yourself or a child or a grandchild. 72T, this is a law allowing you to take a series of equal payments when you're under 59 and a half. So I've had this several cases where higher paying executive, maybe earning a six-figure income, is downsized or his job is eliminated, let go, and he's 55 years old. It's going to be difficult to find a six-figure job at that point. So if they have to take a lesser paying position, we can create some income from the IRA or 401k and not have to pay the 10% penalty. There are some restrictions, so it's important you know what those restrictions are and see if it makes sense for you. Qualified first-time home buyer. This only can be a distribution from an IRA again, not from any company-sponsored plan, up to $10,000. And first-time home buyer, you would think you've never owned a home before, but it actually is that you didn't own a home for the previous 2 years. So a lot of people had foreclosures or short sales going back to 2010, 11, 12. If you haven't owned a home for the previous 2 years, you actually can use your money towards a down payment to purchase a home. And that money doesn't need to be purchasing a home just for yourself. It could be your spouse, one of your children, a grandchild, or a parent. Now the IRS has been very liberal on this. They were very kind to allow you to take retirement plan distributions if you have an IRS levy. So that's a way they can get their money and ensure that you're not paying that extra penalty. So you have some incentive. Medical. Unreimbursed medical expenses, anything over 10% of your adjusted gross income. Health insurance premiums while unemployed. And the 60-day rollover. I've seen some errors made with the 60-day rollover. If it comes out of a 401k plan and the check is written to you, they must take 20% withholding. That money is going to go to your federal taxes, and you may eventually get it back, but you have to pay tax on the withholding. So on $100,000, they would take $20,000 in tax. You would have to claim the $20,000 as income that you did the 60-day roller over on $80,000, and you would probably get some of the refund back, but you don't have the full amount working for you. So in any situation, wherever possible, I encourage people to do a trustee-to-trustee transfer. Do not touch the money. Take possession of the money in a check made out to you.